If you think the great investors who profit in a crash are mainly getting rich because they are pessimists, then you are studying the wrong lesson. That is the first thing I would tell you. The second thing is even more important. The real edge in a falling market is not negativity. It is structure. It is understanding who is leveraged, who is pretending, who must refinance, who cannot survive a price move, who will be forced to sell, and who will still have cash, patience, and emotional control when the entire system begins liquidating certainty. That is where the money is. Not in looking gloomy, not in sounding clever on television, not in saying a bubble exists. Bubbles exist all the time. The question is always the same. What turns the bubble from a stupid but durable story into a forced transfer of wealth? That is the question the public almost never asks, and that is why the public almost never gets paid when the story breaks. When people hear about shorting the market, they imagine something dramatic. They think of a genius in a dark room making a heroic bet against the madness of the crowd. They think of one great act of courage, one giant trade, one cinematic insight. That is not how I think about it. I think of shorting as one small visible part of a much larger machine. A market crash is not mainly a philosophical event. It is a plumbing event. It is leverage meeting price. It is borrowed confidence meeting time. It is collateral losing altitude. It is lenders calling. It is weak hands discovering they were never investors at all. They were renters of risk. That is why the story in your source document is more valuable than it first appears. On the surface, it explains what shorting is and how it works, including borrowing shares, selling them, and buying them back lower if the thesis is correct. It also explains why losses can become unlimited when the trade goes the other way. Fay Filocyte Fay Turn 42 File 0 Fay Fine. That is useful, but the deeper line hiding underneath the explanation is much more important. It is not really about shorting. It is about asymmetry. It is about understanding that in markets, falling prices do not merely create losses. They reveal who is living on borrowed stability. That is where extraordinary opportunities come from. I want you to picture the market not as a giant voting machine first, but as a giant tower built from promises. At the bottom are cash flows, above them are narratives, above those are multiples. Above those are leverage positions, above those are second-order bets built on the assumption that the lower layers will keep behaving. Everything looks stable while the structure is rising. Then one day a crack appears far below the level where the crowd is staring. The crowd sees a wobble in price. The serious investor asks a much colder question. How many promises depend on this price not wobbling? That is where the real opportunity lives. This is why Michael Burry's famous trade matters less to me as a personality story and more as a diagnostic framework. He did not merely bet against housing. He identified that an enormous financial system had written layers of false confidence on top of weak underlying assets. The source document uses the Big Short to introduce the idea, but it is most useful when it shifts from movie mythology into the actual mechanics of betting against weakness. Fay Filocyte Fay Turn 42 File 0 Fay, that is the adult move. Separate the movie from the mechanism. The mechanism is what survives, and the mechanism is brutal. Markets do not fall gracefully once enough borrowed money is involved. They convulse, and every convulsion creates both pain and transfer. That is why I want to start not with shorting itself, but with the 3 ways to profit from collapse. The first is direct opposition. That is classic shorting. Borrow the shares, sell them, buy them back lower if you are right. The decline itself becomes your income. The second is structured opposition. That includes tools like inverse funds or options or other vehicles built to gain from falling markets without you personally borrowing the stock. The third is indirect opposition. This is the oldest and often the safest way. You do not try to make the fall itself your profit center. You preserve liquidity, wait for the forced sellers, and buy what panic. Margin calls and liquidation made absurdly cheap. Those are the 3. The public spends all its time talking about the first. The rich often make their largest fortunes through the third. That is the distinction I care about, because the average person hears the phrase, short the market, and immediately becomes fascinated by technical tricks. Borrowing, margin inverse ETFs, daily resets. Fine. The source document explains those mechanics clearly, including margin accounts, the broker's right to demand more money, and why short losses can be theoretically unlimited, while gains are capped because a stock can only fall to 0. Fay Filocyte Fay Turn 42 File 0 Fay. That is exactly why I tell most people not to fetishize shorting. Shorting is not wrong. It is simply an unforgiving instrument. The mathematics are asymmetrical in a way most people are too emotional to handle. When you buy a stock, the most you can lose is what you put in. When you short a stock, the loss is not naturally capped the same way. If the stock doubles, triples, or gets squeezed higher while you are waiting for logic to prevail, the market can bankrupt you while you are still right in theory. That is one of the deepest lessons in all of investing. Correctness is not enough. Structure matters more than correctness. A man can be dead right and still get carried out. That is why I prefer to think in terms of position rather than opinion. I do not care whether you can explain why a market is insane. I care whether you are positioned to survive the period in which insanity remains solvent. That is the whole game. The source material nods to this when it shows how Michael Burry's trade required ongoing payments and tolerance for interim pain while the bonds rose in quoted value before finally collapsing. It also explains that brokers protect themselves first through margin and automatic closure if a short position goes too far against you. Fay Felicite Fay Turn 42 File 0 Fay, those are not side details. Those are the real details, because they explain why so many intelligent people lose money in correct ideas. They mistake analysis for architecture. They think being right is enough. It is not. You need survival. You need runway. You need enough emotional and financial room that the market's stupidity cannot liquidate your position before your thesis has time to matter. That is why I never begin a discussion of shorting with a trade. I begin with a balance sheet. What is your cash runway? What is your fixed expense load? What is your emotional tolerance for being wrong publicly? What is your tolerance for being right too early? Can you survive a violent move against you? Can you resist the temptation to cover in pain? Can you distinguish between thesis failure and price violence? Those are the real questions. Now let us talk about why the public gets seduced by shorting, because it looks like intelligence made visible in a rising market. Everyone can sound optimistic and look wise in a falling market. The person who called the break looks almost prophetic. That is a dangerous emotional reward. It makes people think the goal is to become the guy who predicts the crash. That is not the goal. The goal is to understand the transfer. A crash is a transfer event. It transfers assets from weak hands to strong hands. It transfers dignity from leverage to liquidity. It transfers time from those who need immediate relief to those who can wait. And sometimes, yes, it transfers money directly to those who structured a clean short. But even there, the deeper truth remains the same. The profit is coming from somebody else's forced revaluation. That is why I say the short seller is not mainly a pessimist. He is a student of pressure. He is studying what breaks first when confidence gets repriced. Now let us talk about the basic mechanics because they matter, but I want to tell them the right way. The source file uses a made-up company to illustrate the trade. You borrow shares at one price, sell them immediately, then later buy them back lower. If the stock falls, Fay Felicite, Fay Turn 42 File 0 Fay Good, that is the skeleton. But the skeleton alone does not tell you why this is one of the most psychologically difficult games in finance. When you buy something, the natural emotional posture is comfortable. You own it. You hope it rises. The world, at least culturally, is on your side. The public wants markets to rise. Governments want markets to rise. Your friends like you better when your account is green. A long investor is swimming with the cultural current. A short seller is swimming against it. He begins by borrowing something he does not own. He sells it first. He profits only if the asset later weakens. He is hated when he is right. He is ridiculed when he is early. And if the asset rises hard enough, he can be destroyed before the market ever validates his thesis. This is why shorting selects for a very unusual kind of personality. You need analytical discipline. Yes, but you also need emotional detachment from the crowd, tolerance for interim pain, and a relationship to risk that is both technical and almost surgical. Most people do not have that. That is not an insult. It is a warning. This is why I think the source is wise to emphasize safer alternatives for ordinary investors, particularly inverse ETFs and the even simpler practice of selling when you believe markets are dangerously overvalued, then waiting with cash to buy after a decline. Fay Felicite, Fay Turn 42 File 0 Fay, that is the real bridge most people need. Not because they are too weak for the big leagues, because the goal is not to cosplay as a hedge fund. The goal is to survive and compound. Now let me say something unfashionable for most ordinary investors. Direct shorting is not the best route to profit from a crash. It is too punitive, too path dependent, too easy to get catastrophically wrong, even with a correct macro thesis. The cleaner route is often one of two things. Either use a defined risk vehicle that cannot wipe you out beyond what you allocated, or hold enough liquidity that the crash itself becomes your shopping season. That is the adult frame. You do not need to be the hero of the decline. You need to be one of the people standing when the forced sale begins. The source document touches on this with its last section, where it says there is an even simpler way to profit from falling markets. Sell when you believe the market is dangerously overpriced, then buy after the crash when prices are cheap again. Fay Felicite, Fay Turn 42, File 0 Fay. Yes, that sounds obvious. It is also one of the hardest disciplines in the world, because the public only pretends to like bargains in real life. The public likes certainty. When prices are high and everyone feels rich, selling looks foolish. When prices collapse and the bargains become real, buying feels terrifying. That is why the simple path is psychologically brutal, even if it is structurally cleaner than shorting. You must be willing to look too cautious at the top and too brave at the bottom. That combination is extraordinarily rare. And it is why so much wealth transfer happens in every serious downturn. Now I want to give you the 3 hidden machines inside any crash. The first machine is leverage. This is the obvious one. Who borrowed too much, who used margin, who depended on rolling debt, who built a business, a portfolio, or a life that only works if refinancing stays easy and prices stay polite. Once leverage is in the system, price declines stop being mere opinions. They become demands. The leveraged holder does not ask whether the asset is still wonderful over 10 years. He asks whether the lender will let him live until next Tuesday. That is a different world. The second machine is liquidity. Some assets are wonderful but hard to sell. Some are mediocre but easy to dump. In a panic, people do not always sell what is worst. They sell what they can. That is why liquidation events create such strange opportunities. Beautiful assets can be hammered because they are liquid enough to raise cash. Trash assets can sit there looking strangely stable because nobody can move them. The smart investor understands that panic often marks what is most sellable, not what is most broken. The third machine is reflexivity. Once prices fall, stories darken. Once stories darken, lenders tighten. Once lenders tighten, forced selling increases. Once forced selling increases, prices fall further. That feedback loop is what turns discomfort into a crash. This is why I keep saying markets are not mainly about prices. They are about interactions. Price hits confidence, confidence hits credit, credit hits behavior, behavior hits price. That is the loop. And if you see the loop early, you do not need a perfect prediction. You need a plan. Now let us come back to shorting because I want to be precise. The source document explains that brokers can lend out shares from margin accounts, that some investors opt into lending programs for a fee, and that short sellers pay borrow fees to access the shares they need. File site turn 42 file 0 Fe. This matters because it reveals something deeper about the market. Everything is someone else's position. The short seller borrows shares from someone who is long. The broker stands in the middle. The lender wants yield. The short seller wants downside exposure. The broker wants protection. In a sense, the whole market is a web of overlapping expectations about time. The long holder thinks patience will be rewarded. The short seller thinks gravity will arrive first. The broker thinks risk can be managed through margin. The market is not a morality play. It is a timing contest inside a legal structure. That is why the best investors care so much about terms. Borrow fee, margin requirement, call provisions, liquidity, time horizon, catalyst. Without terms, a thesis is just theater, and most ordinary people build their financial lives with almost no respect for terms. That is one reason they get repeatedly surprised. Now let us talk about inverse ETFs, because they are often presented as the neat compromise. The source explains them well. Instead of borrowing shares yourself, you buy a fund designed to rise when the market falls. But it also warns that these instruments reset daily and are intended for short term trading, not long-term holding. File site turn 42 file 0 Fe. That warning is crucial. People hear inverse and think they found a clean way to print money from downturns. They found a tool, and tools used badly become injuries. Daily reset matters because path matters. A choppy market can still erode your position even if the broad direction eventually helps your thesis. That is why I say defined risk is not the same as easy money. The downside may be capped in a way. Direct shorting is not good, but complexity remains. This is why most people are still better off thinking in simpler categories. Reduce exposure when prices are euphoric and unsupported. Build cash when the machine looks overextended. Buy fear when liquidation creates absurd discounts. Own some hedges if you understand exactly what they do and what they cost. That is enough. Now, none of this means I am against shorting, far from it. I respect serious short sellers enormously because they perform a function most of the market hates but desperately needs. They test narratives. They expose rot. They force accounting to face gravity. They identify where leverage and fraud and fantasy have traveled too far. But respecting a function is not the same as recommending the activity broadly. This is the same mistake people make with surgery. You can admire the surgeon without deciding every healthy person should perform open heart procedures on the weekend. The craft is real. The risk is real too. Now, I want to say something about crashes themselves. The source file ends by pointing out that major market crashes repeat over time, and that in an ideal world investors would buy when assets are cheap after those collapses. File site turn 42 file 0 Fe. This is a simple statement. It is also a profound one, because the market keeps offering the same broad lesson in different costumes. Booms create narrative confidence. Confidence attracts leverage. Leverage reduces tolerance for volatility. A shock arrives. Prices wobble. The overextended sell. Liquidity vanishes. Assets gap lower. Then, once the weak hands have been purged and the world looks emotionally uninvestable, the patient capital that preserved cash or structured clean downside exposure begins taking ownership from those who could not wait. That is the cycle. And the richest people do not mainly get rich because they can say the word short. They get rich because they understand where in that cycle they are standing. That is the real secret, not a tactic, a location. Are you the forced seller? Are you the nervous holder? Are you the pundit? Are you the short seller with enough runway? Are you the patient buyer with liquidity? That is the only question that matters, because in the end, a crash is not one event. It is 3 events layered together. First, the repricing. Second, the forced selling. Third, the transfer. Most people experience only the first 2. The wealthy participate in the third. That is why I tell people to stop worshiping prediction and start building architecture. If your financial life has no cash reserve, no emotional buffer, no understanding of terms, no respect for leverage, no idea what you would buy in a sell-off, and no way to survive being early, then knowing a crash is coming does almost nothing for you. It just makes you a frightened spectator with a correct opinion that is useless. I would rather be less prophetic and more prepared. Prepared means liquid enough to buy, disciplined enough to wait, thoughtful enough to distinguish between a broken asset and a forced sale, humble enough to know when direct shorting is beyond your mandate, aggressive enough to act when other people are being carried out by the logic they ignored. That is what real investors do. Now let me leave you with the image I think matters most. Imagine a market crash as a theater fire. The audience sees flames, the panicked rush for the exits, the foolish freeze, the arrogant insist the smoke is overblown, the brave try to jump from balconies. But the real transfer of wealth happens outside the theater, where the people who stayed sober enough to preserve cash, read the building plans, and understand where the forced sellers will emerge are already waiting to buy what the crowd will later call surprisingly cheap. That is the whole game. The contract I would make with my future self is simple. I will not confuse being bearish with being prepared. I will not use a dangerous instrument merely because it sounds sophisticated. I will respect the mechanics of shorting, margin, borrow costs, and forced closure before I ever romanticize the trade. I will remember that direct shorting is only one route to profit from collapse, and not the cleanest route for most people. I will build liquidity while others are still admiring the bubble. I will study leverage, liquidity, and reflexivity before I study price alone. I will know what I want to buy before panic makes thinking expensive, and I will remember that the investors who truly profit from falling markets are usually not the ones with the darkest opinions. They are the ones who understood earliest that markets are machines for forced transfer once borrowed confidence begins to break. That is the line, that is the threshold. And once you see it, you stop asking whether you should short the market and start asking a much better question. When the market finally reprices, who will be forced to move first? And how can I already be standing on the other side of that decision?